coming to you raw and unscripted. Beaming across Ontario and beyond to places like Woodbridge, Oshawa, Schaumburg, and Orangeville. This is the Real Hickson Real Estate Podcast. Whether you're listening on your commute or putting on your suit, whether it's your morning stroll or you're on patrol, you just finished prayer or dropped the kids at daycare, you're in the bar, your car, or listening with the bathroom door ajar, near or far, this is the Jess and Giro Show. We're grateful for flattery and prone to inaccuracies. This is your guide to Toronto culture, people, events, news, but most importantly, real estate talk. Yes, hello guys. We're back yet again, and this week, who do we have, Jess?
We have a very special guest, our favorite mortgage broker, our own personal mortgage broker,
Yes.
Lina.
Hello, Lina. How you doing?
Hi, I'm doing very well.
Thanks for coming on the podcast. We are doing mortgages today. It's all about mortgages today. That seems to be a huge topic of conversation in
It's like the main
media.
topic of
Absolutely.
conversation.
And all these rate hikes and stuff. So we're really going to get into it. But first of all, introduce yourself, Lina.
Well, hi, I'm Lina Zaya. I'm with Mortgage Outlet and been an agent for, I'd say, 11 years right now.
Okay.
And pretty well deal with everything, literally from A to Z. Residential, commercial, first mortgage, second mortgage, refinancing, switches, name it. I've done it all.
What do you prefer between residential and commercial?
Oh, definitely residential.
It gets sticky in commercial, doesn't it?
Yeah. It's a lot more complicated. Takes a lot more. So I like the residential part, but I've done both.
She'll do either.
Yeah, I'll take whatever comes my way these days.
And we're pretty thankful because you happen to have one of the offices in our office here at the brokerage at Forest Hill in Vaughan. And we're always picking your brain, aren't we?
Anytime.
But now it's official on the record, we're picking your brain. Okay, so the first thing I usually ask is what's happening in the market. From a mortgage perspective, what's going on?
Well, unless you're under a rock, everybody knows pretty well has been hearing, of course, the interest rates have all gone up. I get calls every day and everyone's going crazy. But what I feel and what's happening now and everything with stats is we're at the peak of it, at the rate hike. There's one more, don't kill me, I'm just a messenger, maybe in December coming, and maybe another quarter point with the variable. But then we're already at our peak pretty much, but they just keep going a little bit higher than that. And then next year, early next year, and first and second quarter, the rates are going to start dropping throughout next year. And by the end,
So we heard that it might hold for the whole year, but are you hearing that, or are you hearing something different?
I'm hearing that it's, again, who knows? I mean, who predicted the Ukraine war, right? Everything can change.
Yeah, exactly.
And the pandemic. But what I'm hearing is this first and second quarter, the rates will start dropping after this December.
Do you think it'll be like just very, very slowly?
It will be slowly, yes, throughout the year. And then by the end of the year, we should be not where we were before, but definitely a lot more better. Fingers crossed.
It's not all bad news.
It's not all bad news. I mean, a lot of people talking about the bubble bursting, or like let's use a balloon as an example. But I heard someone the other day saying that it's not the balloon's not popping right now. It's just someone stick a little pin in it and it's letting out slowly.
That's actually a really good way to say it.
It's exactly what's happening.
I mean, what happened in the U.S., way back 2008, I believe. So we're just more conservative, and in a way, it's not a bad thing compared to the amounts of the housing, how high it went, and then a couple of years ago. So
we all knew what was
it.
happening in February was not sustainable.
Yes.
So and I mean, to be honest with you, in terms of real estate, what's happening? We're seeing places like Richmond Hill. Some places are selling multiples and over asking. So depending on where you're talking about in the GTA, we're seeing a very mixed market still.
Like certain buyers aren't affected, and as you know, they were qualified at the rate at these high rates anyway. So that's why it shouldn't cause as big of a problem, right?
Yeah, because you still have to stress test them.
What's the stress test at the moment?
What the stress test is the greater of The benchmark right now is 5.25, which should stay there for a little bit, or 2% higher than the rate. So if your rate you're getting right now is 5.5, then I have to add 2 points, 7.5, and that's what I have to stress test you at. So with the grader up. And that gives a little bit of cushion to say if the rate goes this high, you know, you're in within your debt servicing.
So that gives a little bit of cushion.
Yeah.
Okay, I have a question. You know, we have the prime rate. We'll get into all the nuts and bolts of what interest rates are and how they work and how they affect us. But let's say we have the prime rate and then lenders set their rates on top of the prime rate to make up their interest rate. Does it get a little bit more competitive? Like, are we seeing like less people getting mortgages over the last quarter, for example? Does that mean that the banks and the lenders start to try and compete against each other, and they might drop their rates a little bit, or?
Good question, because they do compete with each other, and I have I deal with the banks. I mean, Scotia, TD, and the monoline lenders and the credit unions of the world. So I have access to the rates. So we do get preferred rates, and we get special promotions and so on. So yes. So this is why when someone comes to me, I can go into the database, find out what the best rates are out there, whether it be a variable or fixed or 1 year or 2 year or refinance or whatever it is, and go there, because it doesn't make sense for them giving a higher rate, and obviously I'm not going to send the client there. I mean, unless that's, again, it's where you fit in the bucket as well.
But that's the benefit of using a mortgage broker rather than going directly to the bank.
Absolutely, because you go to bank to bank to bank, they all do the same thing. They're all going to put the application, and they have a little box to check where I have one application, one credit bureau, and that's it. I have access to anybody, and I know exactly where to place you.
And your options are much wider.
Yeah, and I'm not partial to anybody, so I do what is best for you. I'm not the person at the bank trying to drag you in there. No,
you don't care.
It's almost like if someone was to deal with just a listing agent versus someone that will show you 10 homes on the street. Kind of thing, right?
Exactly.
Yeah.
Exactly.
Okay, so let's really try and break this down for people. People hear terms and definitions and stuff, and let's try and really figure this out. So, the first question is, what is the Bank of Canada to you? And I know it's probably a huge question, and it probably deserves its own its own podcast rather. But how would you neatly describe Bank of Canada?
We can spend forever getting really technical in Bank of Canada, but just generally speaking, is they set the rate, and basically they set the rates based on the economy, so the way direction's going.
Right.
So they're watching inflation.
So if it's inflation, exactly, or the other way.
Consumer price index and
everything.
Stuff like that.
It gets very technical, but based on that, then they'll come out with, okay, the rate's going to go up, go down to try to stabilize the economy.
Right.
And it's interesting because I've personally been keeping track of it because inflation is such a topical thing at the moment. I found a great website. I check kind of like once a month, and it shows you where the inflation is. And like the last 2 months, in the very least, we've been going down or deflating.
Yes.
So I was very curious to see that they were still hiking the rates. Is there a reason for that?
Exactly.
That's a big question, right?
No, but you're 100% on the ball with that one. You're good. Really, where we are, they should not increase it. They should not have increased the last one.
Yeah.
Now I'm going to get all these calls.
So, Lina, why is it happening?
They've gone beyond that red line where, okay, we're there.
Yeah.
And they just want to go that little bit more higher.
Because they can.
But they, according to all the stats and what's going on, we really already had it. They should not have gone up. But anyway, that's why it's...
Do you think it has anything to do with the US and how they're trying to curb their own inflation rates? Because I know inflation is starting to level out now, whereas ours kind of leveled out a few months back. And they're doing increases. Are we trying to piggyback? Because I guess we're dependent on the U.S. economy
100%.
as well?
Again, absolutely. We do follow and make decisions based on what the U.S. is at, so that you're very right on the ball on that
Deceptive, is that the word?
one. Yeah.
No, I appreciate it.
Careful.
No, because interest rates and all this kind of stuff. That's your world, and and as a realtor, like I know how it affects me and my clients, but I just really try to get a gauge of exactly how it all works. So it's exactly why we had you on today.
Yeah.
Because it's its own whole thing. Okay, so what is the prime rate? What does that mean, prime rate?
Prime rate right now is 5.95. And that's what's been going up throughout this past year is the prime. So that's what the Bank Canada sets. They just recently increased it. And again, like I said, maybe in December. So the prime is 5.95. And on a variable, it could be prime plus, prime minus. It's like with your line of credit. If you have a line of credit, you'll notice on your statement, the prime has changed to 5.95. And if you get depending if prime plus 3, then that's your line of credit.
Okay. I always assumed that it was like prime plus, but in what situation would it be prime minus?
A lot of the mortgages have been throughout the whole year or so. It's been always prime minus.
Okay.
And it depends on your deal.
Right. Okay. Interesting. Okay, the next question is when we talk about A lenders and B lenders or even like C or D lenders, what are we talking about here?
Okay, well, the typical A lenders, you're talking, it's both the banks and the monoline lenders, even the credit unions. They're all A lenders. Each one has their own little niches in how you qualify. But they're all lumped sum with the A side. The B is where you get to... They're like the B lenders are for someone that does not qualify with the A, whether it be you're self-employed, whether it be you have a little bit bruised credit, or you might be you're totally fine. You have a great job, good credit, but you want that little bit of extra money, so they'll give you that little bit of extra. So it varies, and then you get to the C world where it's more or less it's based on. Equity deal. If you have, they don't care too much about your income. It's more if you have the equity in the home. So if anything happens, you default, and so on. And then you got your private lenders and so on. So
second mortgage.
It's second. It just keeps going down, depending what you want and how your credit scores are and where the home is located. There's a lot involved to where to place you. And again, that's where when I have a full application and everything, I know exactly where to place you.
And I guess, have you seen this change a lot in terms of like mortgaging options and avenues and roads to go down?
Yes, yeah. I've gotten a lot more B, and I've gotten a lot more private lending, just because they don't qualify how much they would like to qualify with the banks, and they need to close their home for one reason or another, and they'd rather do that now. Get them in for a year, give them a little breather, and then next year, hopefully when the rates are better, I can move them over to the bank. Or perhaps get them a second mortgage to help them get by, because they don't want to break their first mortgage. That's such a great rate, or there's penalties, and there's different reasons.
Yeah. I mean, like, it's a very complicated world in 2022 in terms of, like, where people work and the kind of employment,
absolutely.
stuff like that. Like... people, influencers, or people on YouTube, or on
Uber drivers.
Uber drivers and stuff like that. It's changed so much, right? It's changed from like a teacher, a fireman, a police officer.
Our good old days with our parents, 9 to 5 jobs. Nobody does that.
Same income every single month. Yeah.
Yes, it's this credit struggle.
Yeah, so you're seeing it all.
Yeah.
And right now, your recommendation, if somebody doesn't have perfect credit or perfect job and they want to get in the market, or they think they can't afford it because the rates are so high, what are you saying? There's
so many options. It comes down to when I see a full application, it's like a puzzle. You put all the pieces together, and then I know exactly where to take you.
Right.
So don't get too discouraged where, I'm self-employed. I've only been employed for a year and the banks require 2 years. Don't worry. I have other lenders that require only a year. Maybe the B side, get you in there before, don't wait another year when the rates and the mortgages, the housing has gone up. Or do you really want to, people that don't claim very much are self-employed. Okay, do you really want to claim to the government, make $200, and then for 2 years taxation?
Yeah, just to get approved for your
claim
mortgage.
$50, and I can, maybe your interest rate's slightly higher.
Yeah, it's costing you a little bit more per month, but you're not getting so dinged on your taxes.
So let's say your mortgage is even $500 more a month.
Yeah.
That's $6,000 a year.
Yeah.
Okay, great. But you know what? You didn't claim $200,000 to the government. You only claimed 50.
Yeah.
Because the B lenders look at it differently.
Yes.
And I can get on. I can go forever on this.
Yeah.
But again,
that's why we call Lina when we.
well, don't be discouraged. I'll tell you where you stand now, and then where you can be in a year or 2 years, and I'll move you up to get you where you need to be.
Right.
So I'm glad that you're saying this because I deal with a lot of first-time home buyers, and I just don't think people realize what's actually possible. And
they think
a
they're
lot of
stuck
people
in whatever they do for the next 30 years.
And they're wondering, I think they try and make up an idea of what a homeowner is going to look like on paper. But I'm always saying to them, and I hope you don't mind, I send you a few people, every month or whatever it is. And some of these people are like, oh, no, I don't want to bother them, all that kind of stuff. But how do you know where you stand until you go through a process?
Exactly,
You know what
exactly.
I mean?
I was talking to someone today and same thing. I said, maybe not today, but send the application, send everything in, and I'll tell you where you stand today and then where you need to be to get you where everything's
exactly.
go. It clears the sky, clears the clouds. They know exactly, because you don't know. And they go to the bank and everyone's, and the banks, they have their strict policies and they just check the box. I'm sorry, you don't qualify. And then when they come to me, I explain why or what they need to do, or maybe they have a family member that can be added to the deal. Like, I give options, or your parents can lend you money, and they're like, I understand why, and I understand where it would, I just like to explain where I don't want to knock the banks down because I deal with them. I have to be careful.
Yeah.
But
it's not
you
for
gotta
everybody.
Almost educate them, and they're so appreciative, and they're not as scared, because it is very intimidating. And you walk in the bank and you don't know what to do.
Yeah, it completely opens your eyes to what's possible.
Yeah.
Well, I mean, the same thing with just trying to educate people on real estate. Even people that have lived in their home for 30 years still don't understand what mortgages mean, or how to go about things. Like our parents, we always say this, they moved into their home in the 80s, for us specifically, and that was it. The idea of moving around or using equity or any of that stuff, there was no education there. And so now it's great to have you on the podcast and trying to explain some of that financial literacy. Even me, I'm still figuring some of this stuff out. So we need to know this stuff.
Yeah.
You know what I mean? It really affects us.
Because it's amazing. People do have, like you said, our parents just pay off the mortgage. You got a, $2 million a home, no mortgage or very little.
Yeah.
It's insane that you should be refinancing and taking out and buying a property and investing and let it pay for itself.
Yeah.
But they're so scared to have a mortggage.
Because the mortgage was such a negative thing, I think, in the 80s. It was
absolutely.
How quickly can I get rid of this debt? But it's actually not bad debt. A mortgage is not.
No, it's still cheap money.
Yeah.
And I mean, that's what amortization rates were for, right? The 25 or the 30 years.
Exactly.
That was okay, I'm going to pay off my home in 25 or 30 years. But what's people doing? People are moving around every 3 to 5, maybe 7 years at the latest.
Being mortgage free in your 30s, that's not even, you don't fathom that. I don't see a place to be mortgage free for a very long.
Would you?
Yeah.
Why would you sit in a home that's $1 million and be mortgage free?
Yeah.
Wouldn't you say, can I take out $200-300, buy a condo, rent it, and then let it pay for itself?
Yeah,
because we've
the
seen
future.
We've seen real estate always it's a very, very profitable to get real estate.
Yeah.
Absolutely.
Especially if you can have somebody paying off your mortgage in a secondary property.
Yeah.
Why wouldn't you?
Yeah. Absolutely.
Yeah.
And I can crunch the numbers and work throughout this with the person, so not for them to be too worried.
Yeah.
And you always find the renters too. So
for sure.
Say, what if I don't find renters? Because you'll always find in this market.
Well, with rental prices right now, I mean, it's almost the same as carrying a mortgage.
It's more.
Yeah, in a lot of cases.
Well, now that the rates are higher, yes.
Yeah.
But before,
But
people are insane. They're telling me, you mean I can pay the same amount as my rent? I just have to come up with a down payment? Yes.
Yes, find the down payment.
Yes.
Yeah.
And I think the important point is here, is as you said, even if you're not ready right now, you can educate people on where they need to be. Okay, is there ways to fix your credit?
That's huge, by the way.
Next time you do your T4, show this and show this. Because what's our default when we go to the accountant? We're trying to get in, especially self-employed people. We're trying to get the best return, right, or pay the least amount of money in our case, especially. But it's a flip side because you want to show enough on your T4, but you don't want to do too many deductions. When you go to qualify someone, they see your NOIs.
But there's still an opportunity, and that's
Well,
what you would go
well,
through.
exactly.
Yeah.
What do you want to do? And everyone's individual, so it's okay. Maybe don't claim very much, and I'll take you to the B lender, and you might be totally happy with that. It's okay if my extra $200 a month on my mortgage. I'm okay with that higher interest. And a lot of my doctors and lawyers, all of them, because they buy these $5 million homes and they want $2 million mortgages, but they claim $100. But then again, I mean, of course, I'm going to try to get you the A side, and not just your 2 years T1 generals. I'll go through there. I can do some add backs and so on, but also ask for your financial statements, because if you do have in there, retained earnings, I would look at beginning, ending. It's kind of so I can add back, take from your retained earnings and your financial statements, and figure out how much you qualify for. So I can qualify for more money.
Right.
So again, there's a lot to it, but when I get all the documents and everything, you'll be surprised of how well I can place your deal. And sorry, back to where we talked about before this is where, okay, this year where you'll be right now, let's get you in, but next year, the next 2 years, I can tell you how to claim your taxes if you really do want to pay out that extra and move
maybe
you
there's
over.
more flexibility on the B side to do like a 1 year or 2 year.
Usually B side, I stick with a 1 year.
Right.
Just because if you need to renew in a year, you just sign the renewal agreement, send it. They're not going to ask you. No questions asked. Fine. But at that time, that's when I would try to figure out if I can place you somewhere better with a better rate.
Right.
Mm-hmm.
Yeah, so it's really just getting in, and then you can figure it out after that.
That's the main thing. Get in, and then we'll work it out.
Yeah.
Yeah.
And you're recommending for clients right now to do a shorter term while the rates are bad if they have to buy right now?
I usually ask a few things. Where are you going to be in 5 years? If you're going to still stay in the house, fine. If you're not, and moving in 2 years, obviously in a year, then we'll do that.
Yeah.
A lot of times I am giving shorter deals, maybe just a 1 year. Let's see where the economy is in another year, and then you can renew with them. Or if you want maybe a variable, because the variable, for example, let's say, prime minus, 25, again, it depends your situation.
Yeah.
Then when prime goes down, your rates will go down and
Right.
so on. But I would not recommend locking a 5-year fix at the high mid 5% or whatever, and for 5 years when we're at the peak. So do a variable or do a short term, and
when you do a variable, you can do you can lock in for a certain amount of years, but it changes as it goes every single month.
yes, yeah, because what you're locked in,
It's complicated.
If you're locked in prime minus 50,
Right.
prime is 5.95.
Okay.
So that's 5.45. Done. Well, if prime drops down to 5, now you're prime minus 50. Again, now you're at 4.5 rate. Great,
Okay.
yay. And if it keeps dropping down to 4, now you're
in a better
3.5.
spot.
Now, most lenders, as it fluctuates, so will your monthly payments, and they'll send you a letter and so on and so on. I do have lenders, some banks that do not fluctuate as the variable goes up and down. It stays the same. It just less goes to your principal mortgage, to your interest. But this is where there's going to be a trigger rate. And right now, a lot of people have hit that trigger rate because now your amortization, you started 25 and now it's like, it's 40 years. And the bank won't do anything, but at your 5-year term, they'll come back and when on renewal, they're going to want to adjust your payments to bring you back to the original amortization where the contract was. So there's a lot of things there happening. But again, I talk to my clients everything, and they're, without trying to fill your head a lot of stuff. I just sit there and say, I focus on you. What's your situation? And this is where it is. And it clears because there's so many things going on out there.
And it's not just black and white.
No.
You just said a lot of words, and I'm sure there's some people at home that are like, "What did Lina just say?" Like, she sounds like a lovely lady, but Lina, let's break down these definitions. Let's first of all break down. I want to go through variable versus fixed, frequency terms, amortization, refinancing, and like penalties and stuff like that. So let's start with variable versus fixed. In simple terms, what's the difference?
Simple, fixed, you got the rate, you locked it in, you got your mortgage, 5 years is not changing.
You can do shorter, like 3.
You can do
4.
1, 2, 3, 4, 5. They even have 7 and 10 year really.
Really?
Yeah.
Okay.
Yeah. A lot of people don't go with that. It's higher rate and so on, but
Okay.
they do have that. It's done. Now, if you break a fixed, it's either 3-month interest or IRD interest rate differential,
We're
the
talking
greater
about penalties, right?
penalties.
Yeah.
So again, this is where if you're going to move before the 5 years, maybe don't lock in a fix because the penalty. And again, I talk to the clients about where you're going to be and
what are your plans?
Yeah, but I mean, from our perspective, let's say you were breaking it when the market was low. Sometimes it is worth it. We actually did it. We broke
Yes.
our mortgage, but what we bought was lower, and then the market went crazy. So it was kind of like worth the penalty for us.
Yeah, sometimes it just ends up being a 3. And the variable is a 3-month interest penalty to break.
Right,
So
so
it
it's
doesn't
not
matter if you're
huge.
breaking a year or
Right.
2 years.
Which is more flexible.
And depending on the rates, you're exactly right, where the fixed, not too long ago when the rates were low, depending on your situation, but you could be just paying a 3-month interest penalty with a fix as well. And it depends on it. But, so in a nutshell, fixed is fixed. The rates your mortgage payment doesn't change. The variable can fluctuate,
Right.
depending. Some lenders,
Prime plus or minus, that you were
yeah,
explaining.
most, yeah.
Okay, what about the frequency terms? So like bi-weekly, accelerated, all those kinds of buzzwords.
General, it's monthly. If people like to do bi-weekly, it's every 2 weeks. You get like 2 paychecks a year, which is great. You can do weekly. Some people just have it towards the way they get paid, their paychecks. So if their paychecks come in every Thursday, they will either every Friday, weekly payments. That way they know what they're going to end up, and it's easy.
Right.
They don't have to wait to the end of the month. So it's a lot of lenders have that, and
And accelerated biweekly is an additional 1 or 2 times a week or a year.
accelerated biweekly is every 2 weeks.
Yeah.
So you get about 2 paychecks a year. You can do bi-monthly, but that's twice a month, which is really the same as monthly. It's only 24 pays in a year. So it's like the
And does
15th and 30th.
That helps pay down the equity better.
The
or?
accelerated biweekly
Accelerated,
does.
yeah.
Yeah.
Okay, so would that affect your amortization schedule? If you were set for like 25 years, is there an advantage to paying it off a little bit quicker?
The amortization stays the same. At the end, when you've gone a 25-year amortization and then gone through the 5-year, at the end, you're going to have 20 years left over.
Right.
It's just your mortgage balance would be reduced because
You're
more, a
paying
little bit
bit more.
Yeah.
Yeah. So
Yeah.
your interest overall is a little bit less.
Yeah.
Okay. Okay. So let's talk about amortization then. It was, as we mentioned earlier, like it's in place for people to have an idea of just people used to pay off their home in 30 years, and now it's just more of a way to break down the payments. Is that true?
Okay. So a few things with the amortization, just so you know, or listeners know, if you put less than 20% down, the maximum is 25 years. Done.
Okay.
If you put 20% or more, the maximum is 30 years.
Okay.
And again, I have lenders that will do the 35, and we'll do, good to the
They'll
B
do
lenders,
more?
and they'll do
Okay.
the 40s and the Bs. So again, this is where the longer the amortization, the lesser the mortgage payments, the more you qualify. And it's where you want to be.
Yeah.
So I can,
There's
again, go on.
flexibility.
So that, generally it's 25 or 30 year people get, and that's it.
Okay. And I know that when we got our mortgage documents, we could see literally they display in a schedule or a table
The amortization
the
schedule?
amortization schedule.
Yeah.
So I would see the first payment all the way through to
Yes.
whatever
Year 30.
year
Yes.
30.
Literally, yes.
Yeah.
And just to talk about the concept of how it works. So again, you were talking about it before. In the beginning, you're paying more interest than principal. Principal being money just directly towards your home. Interest being the fee basically for having the mortgage.
Exactly.
And as you go towards the end of the schedule, the 30 years, the 25 years, you're now changing the different proportions of principal versus interest, right?
Yeah. So normally the amortization is just your terms. If you have a 5-year term, the page will just show the 5-year term. Where you are now, and it breaks it down to interest. You're paying, whatever you're paying per month, and it breaks it down to interest and principal payments. And literally each month, a little bit more goes to your principal, and a little bit less goes to your interest. because the balance is
Lower.
reduced, basically. Yes. So you'll see that on the amortization as you pay down the principal. A little bit more of your monthly mortgage payments will go to your principal, less interest.
Right. And besides getting all, caught up in all that stuff, at the end of the day, it's just your monthly mortgage payment, right? That's all what it's all about. Plus your maintenance and fees and all that kind of stuff. So the idea of, okay, let's say you bought your first condo and you gained a little bit of equity or a lot of equity if you're lucky, in this volatile Toronto market. As you're going to the next place, let's talk about like upgrading the home. So in some instances, you can port the mortgage, correct?
Yes. Yeah, depending on the lender, but majority of them, they'll port the mortgage.
Okay.
Now, again, everything is general, I'm talking, because the lenders might be different, or they are different. But when you port, you're porting the same money. If you have a balance, whatever the balance of your mortgage is, $400,000, let's just say, you're porting it. If you need more money, that new money, if you said, you know what, my mortgage $400, I'm going to port it, but I need an extra $100. That extra $100, so it becomes $500. It's different ways. It could be, all right, the extra $100 would be today's rate, because it's new money. Or we'll blend and extend. Oh, you have another 3-year term. We'll bring you back to a 5-year. We'll give you $500, and they'll do the math.
Right. So there's ways around.
There's
it.
ways, and if it's less, then you pay the penalties and difference. But then I'll tell you to. There's ways of kind of reducing interest.
There's people that signed a year ago at 1.3, but they need to move, so it maybe makes sense to take that existing mortgage and then bring it to the next property,
and then maybe top it up, and then when the time comes and the rates are lower, you can just consolidate all together.
Okay, so there's lots of ways around.
There's a lot, yeah.
Okay, so let's talk about. I mean, I always like to tell, especially my first-time buyers as well, is in terms of making the next moves. When you make the next moves, obviously the idea is to pay down part of your mortgage. It's not realistic to be paying all of your mortgage within 5 years or whatever, unless you have a windfall.
Yeah, seriously.
But the idea is to generate a little bit of equity and pay into the mortgage, so you're chipping away at it. And then, you go to the next step. So I always talk in terms of a refinancing goal, right? Aim to, because we want to avoid these penalties, as we're talking about. So, ideally, it's hard to time the market and your life and what's changing in your life, but making that next step, it makes the most sense on paper if you were to wait that 2-year, 3-year, 5-year period, correct?
Well, you build the equity in the home, and I get people that they just decided to keep their existing property and keep it as a rental, and maybe refinance because there is so much equity. Take that out and put it towards their new owner occupied. And people, they can sell it.
When someone refinances, just an average person, they've been in their home for 5 years, it's time to refinance. Is the qualification any easier on the second time around because there's more equity in the home?
Depends. I will say it depends. It depends on lender.
Yeah.
Where, let's go back to the basic. Then no, math is math. So if you want to refinance, that's fine. Your income versus all your other debts, and the math is there, and you're refinancing. So it's not any different than any other method of doing regular mortgage. But if you want more money, I can always go outwards and give you more. But generally speaking, no, the refinancing is the same. It all comes down to math, your debts versus your income, and it spits out a GDS, TDS.
Yeah.
So I guess you should always be mindful of where you are in your employment and credit and all that kind of stuff. Let's say you qualified quite easily when you got your mortgage and now you're refinancing. I guess, as you've mentioned before, you could just tick yes and keep going on the new rate that your current lender has got you at. But if you were trying to move to the A side, for example, or if you wanted to change lenders, you would have to requalify, as you're saying, right?
Yeah, and a lot of times I've done quite a few where they just refinanced, paid off their debts. They have a lot of credit card debts, line of credits. You can have a lot of credit, a lot of debts, and be paying $1,000 a month interest only on your credit cards. But I would consolidate the debts, refinance, put in their mortgage, and then what I've done with quite a few is I extended their amortization back to the maximum, where it could be 25 or 30 years, whatever. And then their mortgage payments ended up being the same, but I cleared them up. I cleared one person for $100,000 in debts.
Wow.
It was, very close to $100,000, and I extended amortization. I said, okay, your mortgage payments stayed the same, and you just got rid of, yes, it's in there, yes, but they didn't care because at this point you need to get out of the hole.
Yeah.
So they have no more debts.
Yeah.
The mortgage payments stayed the same because I was able to
They're
go
carrying
back
the same amount of expenses.
to a longer amortization, and at this point they're just happy to, it's cash flow at the end.
Yeah. And when they sell their house, they deal with it.
Exactly. At that point, it's
Yeah.
it's always looking, where do you want to be, and then we'll talk, and I'll get them there the best way I can.
Yeah. I've personally heard a few people that had gotten variables last year and when they bought in the last couple of years, and obviously like the rates have gone up quite high, so they're starting to hurt. And I know you and I have had a conversation before about what options do they have if we're talking about all this like positive of like generating equity, but sometimes you need to take a step back in order to try and move forward. So how can people help themselves out? Maybe pulling out a little bit of the money for themselves and refinancing.
I've done a few of that actually.
Flipping from variable to a fixed. That kind of stuff.
See, but at this point you're flipping from high to high.
Yeah.
It's like,
Yeah,
hey, right?
Might as well just hope that it gets better.
So what's the advice? So stay on the variable.
A lot of people, surprisingly, a lot of people have managed. Maybe because our stress test is in there. It's their wants versus their needs and so on. Because you'd be surprised that they've actually managed, and this is, again, I guess a stress test, but I definitely have done quite a few second mortgages, a small amount, could be 50, could be 100,000, because they got the 199 or 1.5 rate, and, they don't want to break it because their mortgage. So I've done that. I said, okay, your mortgage is coming due in 2 years, fine. I've given that. They can breathe. Let's consolidate your dets. You're paying 20, whatever the credit card is, 19, 20, 29,
Huge,
where maybe I'll give you on a second mortgage, even if I gave you, let's say 12%.
Yeah, it's still less.
Fine. It's still less. They breathe. In a year or two when mortgage is coming or when the rates are better, then they'll come back and I'll refinance them and we'll get them going. Because I'm not, if their mortgage is 700-800 and they need an extra 100, I'm not going to go break it and get them an $800,000 mortgage first at a 5% plus where. So I've done quite a few of that, second mortgages to get them going, and we'll pay off their car payments, whatever it is.
Okay, so it's like debt consolidation as well.
It is, without hurting them, really.
Yeah,
I mean, it's
because again, like mortgages are good debt, credit cards, car payments, as you said, and then even line of credits are more like a better debt than
credit cards, for sure. Because generally it's lesser of an interest rate.
Yeah.
But
I mean, that's a whole other episode. Financial literacy, but like this is.
They should be taught in school. That's
this stuff should be taught.
I think there was something to do. They were going to talk about financing more. I don't know. My kids are older, so I don't know much now.
Yeah, we've been out of school a while, but
I've always had this idea. I'm like, why can't they teach? It's called world class, right? And you go in, you learn how to change a tire, you learn how to take your tax back. You learn how how interest rates work. You know what I mean? How what real estate. This stuff just doesn't get taught.
Absolutely.
Okay, but apart from the depressing, sad stuff of people hurting and stuff, which we have to talk about. Let's talk about what's the goal here. So the goal is to typically a buyer, they're looking to get their first place. Great. Then they build a little bit of equity. Then they move on, and they're mindful of refinancing. They're mindful of keeping their eye on spending habits and being able to just hold on to that piece of paper, which is the deed for the home. And so the goal, would you say, is to eventually, let's say you get your dream home. Is that the point to which you start trying to pay off your whole mortgage, or is it a better strategy to start looking at, okay, now I've got here and I can manage this. I'm going to chip away at this mortgage every year for the next however long because I'm here for a while now. Do you get an investment condo or something like that?
I think it's the individual. Some people are just not risk takers.
Yeah.
And some people are. And in my experience, all the ones I've helped that have taken a risk, even if just having bread and peanut butter for a bit, in a few years have made 100, 200 and they're thankful that they've done that. But it's up to an individual. Best I can do is just do the math and walk them through it and see if they're comfortable.
What the possibilities are.
Yeah.
Cool.
So it's
I don't
not
know.
always terrifying.
It's not always terrifying, no.
You can learn a lot.
And this is, for me, I always talk about like wealth building. This is the kind of stuff, like some people have inheritance from their parents. Some people are not so lucky and they have to build everything from scratch for themselves. But it's all about, first of all, I think just understanding how this all works and then applying it in your own situation and using people like yourself, Lina, to help them and obviously Jess and Jerome.
Our
Of
phone's
course.
going to go like ring off the hook.
Yeah. But highly, highly, highly recommend for everybody is just get a pre-approval. If it's not now, it's in a year from now you're thinking, get it now, because there's a lot of stuff that I see in a credit bureau or how to fix a credit. They have no clue to prepare them. Just if you don't plan on buying now, figure out where you stand now and yeah, in a year from now, and they're not going to help them out, because just simple things like, you know, don't go take out 2 card payments and don't do this and that, or don't pay a cent events.
Right.
That it's so there's so many more things. Really quick example, I had a client that was 30 something years old a few years back and wanted to get a mortgage, bought a house, everything, and okay, no problem. I go, how's your credit? Excellent. My credit's beautiful, great credit, great. In the mid-30s. So I pulled the credit score. There is no score. There's no credit. I said, there's no credit. He goes, yeah, I pay everything cash. I go, okay,
that
so
doesn't make you have good credit.
So
Isn't it hard to have zero credit?
he didn't believe in credit cards, so he just wanted to pay everything cash. First of all, I raised an eyebrow there, but anyway.
But don't you? Okay, if you open a bank account and have a mobile phone, that generates credit, right?
But he's at this age, and it's not like new to Canada. It's nothing like that.
Right.
End of the day,
He's just not
I got
on
him
the
the
books.
deal. He just had to add his dad. Not for income wise, because the guy qualified. It's just to add the ad to for lack of credit history. I had to explain to him, and yes, I had to get maybe some phone bills, some if he was renting, stuff like that.
Yeah.
But again, these are the things that come to me. I can tell you, get a second credit card and use it and pay
grow
it.
your
Put gas and
credit.
pay it. If they ask you, do you want to increase your limit? Say yes, because when they ask you, they don't pull a check. They just
Yeah.
and that way. Yeah, again, I'm going to try.
Yeah.
But if you have a $1,000 credit card and you're always at $900, don't pay the extra $50 or pay $100. Pay more than you're supposed to pay. Try to keep it. But if they increase your limit to $5,000, but you're only used to using $1,000, then they're like, okay, this person rarely maxes out their credit card, so it always looks good. So I talk to them of where your credit is right now.
Yeah.
And
Make a
how to even
plan.
make it even better.
Yeah.
And
Okay.
or use it. Don't
So you're
leave
saying
it.
to overpay? Did you say before to overpay your credit cards?
Overpay the minimum. So it's if you get it through and it's $50, don't just pay $50.
Right,
Put
right,
$100. Put
Yeah.
$60.
Yeah, okay.
Just always put a little
Try
bit
not
more.
to be at the top of your credit.
Not the top of the
allowance.
credit, and always pay a little bit more than just your minimum balance.
Yes.
It's good. And try not to be more than 50, 60, 70% usage. So I like to say, if you have a couple credit cards, a few credit cards, don't have one max, and the other one empty.
Right.
Maybe spread it out so it doesn't look like. So there's kind of ways that best thing to do, of course, pay it off and use it every month.
I've heard, and this is through an app that I use that checks my credit and stuff like that. Without saying the name, it's a pretty obvious one. They say to you to pay off your credit card using a line of credit, and then pay off that line of credit to mix up the use of. Like do they want to see that you're using lines of credit and then paying it off responsibly, or what's the takeaway here?
You know what? That's something I thought about. I'm not going to lie to you, where I'm thinking, I'm not 100% sure.
Okay.
I'm going to say I'm not. Because if you're paying off, Peter to pay Paul, I don't think that's good. Mm-hmm. But that's something I actually want to look into. So
Okay, all right.
Yeah.
It's a little bit of homework.
Because
I'll get back to you guys
it's almost
on that.
like a cash advance, right? So how does that really work?
Yeah.
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 But then it can get very messy if you start using line of credit to pay your credit card and
That's
not
what I'm
paying
thinking,
either
because it's like a cash
off.
advance is what it is.
Yeah.
Well, my credit rating did go up the following month, so I don't know if there's anything to do.
Maybe.
Not by much, but it was
Maybe I'll
Yeah.
try and see.
something.
Yeah.
Never overspend spend yourself. That's it.
Oh,
Number
never,
one.
ever go over your credit limit.
Yes.
And if you do, go online and, if you happen to do, pay it down before the next report goes to Equifax or
That
the
really kills
TransUnion, because it will drop your score quite a bit.
Okay.
Even if it's like $100 over your
Right.
limit or $50, don't bring it down.
Okay. Good advice.
Just, again, a lot of little things
Yeah.
I'll talk about.
Speaking of advice, let's talk to the millennials. Let's talk to the people that aren't even in this yet. Is your advice to just stop spending money on stupid stuff, Lina? Is that what?
Yes, Jesus. What the hell? Nobody cooks. You see them out in restaurants. And
This is
I
kind
know,
of
it's
what
very
I
expensive
say.
to be out at restaurants
they're
right
almost
now.
taking pictures and having these margarita drinks. And
I
they're like
mean,
$15 a shot. I'm like,
To
what
be
the
honest,
hell?
we're like 46 minutes into this,
Okay.
and we're almost done. And I would be surprised if any millennials are still listening to, with their attention span.
Oh, ouch.
Hey, we're millennials. We're allowed to say it.
No.
But yeah, like I always talk, like, how about if you spent the next 5 to 10 years making a bunch of sacrifices and getting that first down payment, or maybe if you already had a place and you're trying to upgrade, to just make that sacrifice and then set yourself up for the future. This is future building, right?
Yeah, it all comes down to come to me, let's do a pre-approval. Where do you want to be? Where you see yourself? They'll be very surprised on how much little change maybe they need to do.
Yeah.
What's important to you.
Make a plan.
Just to open your eyes, yes. And then go from there. And again, with the down payment, I mean, I don't know what you're going to buy for $500,000, but basically minimum down payment is 5%. Of course, you have to qualify for the mortgage, but 5% the first $500,000.
Yeah.
That's
A lot of people don't know that.
That's $25,000.
Yeah.
Yeah.
If it's more,
And you might not even have that. Fine, maybe that's a bigger issue. But you're overspending. But you could just get that from. Some people can get it from their parents.
yes,
as
absolutely.
a loan
you can have
thing.
gifted money.
And I always talk about this too. Like I don't feel like people should feel ashamed or embarrassed maybe to ask for help from their family or
It's possible.
because we live in this market where it's like $500,000.
Sure, and if your
starting
parents have a
entry
$2 million home with no mortgage,
Yeah, maybe they can.
maybe this.
Yeah, exactly.
Yeah.
Okay, I think that about wraps it up. Is there any last words of wisdom that you wanna give to
It's
them?
never too early to figure out where you stand right now.
Okay, that's a
That's
good
the
takeaway.
bottom line.
Yeah.
Never. And again,
Ask questions.
I don't charge any fees. So my service, I mean, you can come talk to me, have one-on-one consultation, and it's whatever. Obviously, it's specific to your own situation, and then it just helps clear the air.
Yeah. Ask questions.
Yeah, yeah, and I ask everything between your credit cards, what you have, and your debts, and so on. We go through everything to make sure you're clear, and that helps.
Amazing. Well, again, thanks so much for
Thank
coming
you
on the
so
show.
much. That was
Welcome.
great.
Thank you.
It's a lot to take in, but I guess any other questions? Where can...
We're holding you to the rates going down.
Yeah, that's it. We've got you on record.
I'm not the Prime Minister.
But if anyone wanted to kind of reach out to you, you guys can come to us. We always refer Lina. Have you got a good email address they can email you at?
Yeah, just my first name, Lina, Lina, at mortgageoutlet.ca.
Mortgageoutlet.ca. Perfect. Guys,
We'll
if you have
tag you
any
on
other
the
questions,
Instagram
we'll put it all on the
Yes,
socials.
yes, thank you,
Please.
thank you.
And again, if you have any other real estate related questions, guys, reach out hicksonrealestateteam at gmail.com. And otherwise, catch us on TikTok, on Spotify, podcast, all these kinds of podcast
Apple
platforms,
Music.
Apple Music, and of course, like Instagram and Facebook and all the regular stuff. We're not on Snapchat though, Jess.
No, we're too old for that.
We're too
No.
old for that. All right, thanks.
Okay, thanks, Lina.
Again, Lina.
Thank you.
And we'll see you guys next week.